Welcome back to the Rick Smith Show. Now, here is Rick Smith.
So Wall Street has had one of its worst weeks since October, they're saying, and they're blaming it partially, or I guess mostly, on the what's going on with GameStop. Their stock up, like 400% over the last week, like 1,600% over the last month. And lots of chaos going on around that. And, my mind is this is gambling. It's Wall Street. It's who it is. It's what they do. And some people figured out how to rig the system a little bit and make themselves a boatload of money. Question I have is what happens on the downside when this stock gets back to where it should be? Who gets left holding the bag? And it's probably going to be the little guy. But we'll see how that goes out. Here to explain what this is, how it is, why it is, all the ins and outs. I've asked Dean Baker to come talk with us. Dean is a senior economist at the Center for Economic and Policy Research. He's got a new piece out, the GameStop game and financial transaction taxes. Dean, thanks for taking time for us.
Thanks for having me on, Rick.
So let's start with, how did this happen?
Okay, this is kind of a humorous story. It's a little complicated, but I'll try to just get to the basics. So GameStop, and I'll be the first here, I don't know a lot about GameStop. I literally had never heard of it until this adventure. But GameStop, many of your listeners, I'm sure, know way more about it than I do. But apparently it's a brick-and-mortar store where they sell video games, so online gaming. And anyhow, it's been hard hit, like many brick-and-mortar stores, even prior to the pandemic. But it went down even more with the pandemic. I should say its sales went down because obviously a lot of people aren't going out, and that's probably not their first priority if they are. So anyhow, it's been in very bad financial shape. And what happened, the basic story here is that Melvin Capital, the hedge fund, shorted GameStop. So what shorting means is that you sell the shares, you sell them at whatever the current price is. It had been around 20. I don't know when Melvin got in, did their short, but it had been around 20 if you go back a month or so ago. They shorted them, and the idea is that you have to buy them back at some point in the future. And the anticipation when you short a stock is that the price is going to fall. So you'll buy it back. If you shorted it at 20, in fact sold shares at 20, you'll buy it back at 10 or something like that. And then you can make a lot of money. At least if that happens, as you expect, in a relatively short period of time, you could do very well. So that's a common thing that, hedge funds, people with money tend to do. You wouldn't expect a small investor to do that. Well, the story here was that you have this Reddit finance, and you have Robinhood, a trading platform where people could trade at very low cost. And you have people on Reddit saying, let's get together and let's buy this stock. Let's buy GameStop. And I can't speak for what was going through their heads in terms of whether they thought GameStop was actually a good company or whether they just thought it was clever that, here's this big hedge fund with a big short position. Let's cause them some trouble. So, again, I can't speak to their motive. But the point was you had a lot of people, a lot of smaller investors with, 5,000, 10,000, some have paid more, many had less. And they all bought up GameStop at the same time. And it sent the price soaring. And suddenly Melvin Capital's in a situation where instead of being able to sell it at 10, the price is 40, the price is 50. It eventually peaked at over 400. And suddenly they were looking at a really big loss. Now, what likely happened, there's something that's referred to as a short squeeze, that when the price starts to go up, they have to close out their position because they can't cover it. And this is, again, I don't want to get too complicated here, but suppose that I had bought the stock at 20 and it goes down. Well, the most I could lose is $20 a share.
Correct.
I'm not happy about that, but that's the most I could lose. If I shorted at 20, well, I could lose, if it goes to 100, if it goes to 200, I could lose a huge amount. So Melvin Capital apparently hadn't covered their bet. You can get insurance. They won't go into details on that, but you can insure in various ways. But apparently they didn't. So what that meant was when the price started to go up, they suddenly had to buy the shares, contributing to go up even more. So it sent the stock absolutely soaring. Again, it peaked at over 400. I'm not sure what the absolute peak was, but it was over 400. And it since has come down some, but I think it's still 280. I haven't checked the latest number on it. But it's still at a very, very high price. And, again, it's, you'd said what happened when it goes back down to earth. Well, presumably the people who bought it at 400 or bought it at 280, they're going to take a very big hit. Again, I can't speak to the company's prospects because I haven't tried to analyze it, but just on the face of it, I sort of think Melvin Capital is probably smart to short it because it doesn't look. Again, you could buy these games online,
Right.
so the advantage of being over to a store, a brick and mortar store, it doesn't sound like it's really worth very much.
Yeah, they're the Blockbuster of video games.
Yeah, that's what it sounds like. And Blockbuster, I imagine probably a lot of your listeners don't even know what Blockbuster is, but yeah, they were huge back when we had video cassettes first come out. We all went out and rented them. I did that. You did that, I'm sure, because that was how you got them. But, that's ancient history now, and they're long since out of business.
And I look at GameStop, and my question as this was going on is, why would you jump in the middle of this? Why would an investor jump in the middle of this? Because it's great while it's going up. If you bought at the bottom and it's going up, you want to continue to go up. But eventually it's got to come back down, and eventually someone's got to get bit. No.
That would be my expectations. You like to think, I in my piece, I sort of make a little fun of the idea of companies having true value, but at the end of the day, you do think that company stock price is at least in some way related to its profit. Now, I don't think it's a close relationship because we see all sorts of movements in the stock market. This is really extraordinary, but it's not unusual to see, stock go up 20% in the course of a month or 2 months and then go down by that amount and go, well, what was the right price? Well, maybe God knows, but I don't know, So, but,
it's the invisible
is it
hand,
gonna
right?
stay at 280 or something? Very hard for me to believe, but I'll just throw in my other qualification on this. Bitcoin, the outstanding value of Bitcoin, I saw it somewhere around $1.7 trillion. And what's Bitcoin? Well, it's literally nothing. So, do I think Bitcoin is worth 1.7 trillion or even 170 billion or even 17 billion? Answer no. But fact is, it's gone up. Maybe it'll go up more. I really have no idea. But it doesn't seem to have any intrinsic value as far as I could tell.
Yeah. Now, ultimately, this comes down to what I've always said about Wall Street. It's not investing; it's gambling. For the people who put their money into IRAs and their 401ks and their retirement plans, that's a little bit more long-term thinking, a little bit more of what we would think of as investing. But for the most part, when I think of Wall Street, I think of supercomputers making millions of trades a second. I think of people playing for pennies, and it's really just like a casino, and it's just like gambling. Is there a way to maybe pull some of this back? Your piece was about financial transaction taxes, which I'm a huge fan of. We should have had those continuous from they were back in the 60s, I think, when we had the Tobin tax. I think it was, but
Yeah.
This isn't investing. This is gambling. Is my point.
Yeah. So when you see certainly what's going on with GameStop, this is gambling. And again, some people could end up winners. Just like if you go to Las Vegas and you're lucky on the casino, you could walk away with a lot of money. Most people don't, of course. That's why the casinos are very wealthy. But yeah, it's gambling, and people end up losing money. A lot of people end up losing money. And it adds nothing to the economy, adds nothing to the market. So if you could discourage this with a modest tax, and I actually mentioned this piece, Representative Peter DeFazio just proposed a financial transactions tax. This is before this. I don't forget any idea this is going to happen last week. He proposed a modest financial transaction tax, 0.1% on a sale. So what that would mean is that if I sold $100 of stock, I would pay 10 cents of tax. So he proposes a modest tax, and that would have the effect of discouraging at least some of this gaming. So you'd mentioned before people buying and selling on a second, which you literally have. You have high-frequency trading where it matters to these traders literally a tenth or hundredth of a second. I'm not kidding at all. They spend a lot of money so that they can make their trade, millisecond faster than their competitors because that's how they make their money. That adds nothing to the stock market, adds nothing to value. It's just a question, can they get the money rather than an ordinary investor?
Yeah.
So if you could if you could drive those people out with a modest tax, and this tax certainly would do that, a tenth of a percentage point, to my mind, that's all for the good. Now, that's not going to get all the gamblers out, but it will get some of them out. And at the very least, as I say in this piece, at the very least, we'll make some money on it. So, I throw out some hypothetical numbers. I really don't know how much money is going back and forth with GameStop. I said, let's imagine it's $50 billion. Well, with this tax, that would get the government $50 million. Now, the huge sum in a $5 trillion budget, but also not totally chump change. So, to my mind, it makes the markets more efficient, better, things operate better, and to get some money for the government.
No, I'm not a senior economist or an economist at all, but my mindset has always been I'm a big fan of a really heavy tax on trades done within minutes. You keep a stock a week, maybe we lower the tax. You keep it a year, maybe we say after if you've held it a year, there's no tax at all. Because for me, the idea is investing. If you're investing in something, that's not by second turnaround. Is there anybody talking about something like that? Because I think you have to punish the people who are really turning this into gambling and rewarding people who are truly investing.
Well, the problem with trying to do it by time, and people have talked about that, and I've looked into that. I think it is hard to do it in a way that can't easily be gamed. So I worry that the effort to do that might end up coming short in the sense that people will find ways around it. Because obviously there's a lot of money at stake, and if
They
they
always
find
do.
a way to get around it, they will. I mean, we do have some incentives that way in the sense that the tax system as it is now, if you hold a stock, I should know this, I believe it's more than 6 months, it might be a year, it's been changed at different points. But in any case, you pay a capital gains tax rate, which is, for high income people, it's 20%, as opposed to the tax rate of normal income, which is 37%. So that does discourage, at least as individuals. Now, from the standpoint of a company that, is paying corporate tax rate, it won't matter at all. But if you or I, we're looking to buy a stock at 2 o'clock and sell it at 3, we would be paying a higher tax rate if doing that rather than holding it for a year.
Interesting. Let me ask you the other side of this. Is what happened with GameStop and I guess AMC and I guess there's some other ones. Is this a bad thing? I mean, is this something that should be strictly discouraged? Outside of what the companies were doing, with Robinhood, shutting off trading and some of the stuff along that. And now we find out that Robinhood was figuring out where people were putting stuff and using that, selling that data. At least that's what I've been told. Is this a bad thing to have happen?
Yeah, well, there's an issue of stock manipulation, which I think is bad, and it happens. It's not uncommon to happen. So you have a lot of big actors in the market who do play games with stocks. So one of the things that you could try to do, not you or I probably, I don't know how much money you have, but I get you don't have billions sitting around. So you start buying up shares of the stock, driving up the price. Other people see that the price is going up, and they start buying it, and then you dump your shares. So that's an old trick, dates back from forever probably. But that's something that, if you have a lot of money, you could do. Now, that's illegal if it could be shown that that's what you were doing. Now, unless you're really foolish, you don't write emails all over the place saying, hey, I'm pushing up the price of this or that stock. So it's hard to track that down. Doesn't mean it doesn't happen. It's just that it's hard for that to be tracked down and for the Securities and Exchange Commission to have civil penalties or even criminal penalties if you could prove it at that level. In this case, it does look like it's an issue of stock manipulation. Again, I haven't gone through what was going through people's heads, what people are writing on Reddit. But if you had people saying, oh, let's drive up the price, not because they think that GameStop's a good company, not that they think that GameStop's really worth, 100 or 200 or 300. They just go, hey, let's screw Melvin Capital and, push up the price. Well, in principle, that's illegal, So, I'm not anxious to see these guys going after. I don't think anything's criminal. I don't think anyone's going to end up in jail. But if they actually acted to manipulate the price, then that's in principle illegal. And, again, a lot of people will say, well, what about the big boys on Wall Street? They never get caught. Well, that's true. But if you do it out in the open, if you're on Reddit and you're writing it down, let's go do it. Well, then, they have the evidence. So if you did this to manipulate the stock price, that is illegal. And, again, we're better off in a market where no one's manipulating it. Again, I don't mean to say for a minute that these are the only people who ever tried to manipulate stocks. That's, of course, not true. But they had the misfortune that they did it openly. Again, I don't know anyone's going to try to pursue them, but that is against the law.
Yeah, it's interesting. As I've been mocking the people who engaged in the riot and the sedition on January 6th of recording their own treason on social media. And you've got these folks who are who are committing crimes in the open. So the question is, do people go after them? Because there got to be millions of them, right?
there's a large number. Again, I don't know how many were involved. I mean, the other source you could go after is Robinhood and Reddit. And again, what their responsibilities are as platforms, you'd have to look at very carefully. But in principle, if you're a knowing party to the manipulation, which at some point Robinhood presumably was, I mean, you do have people running the company that I imagine aren't morons, they know what's going on, then there may be an issue of liability there. Again, I'm not enough of a legal expert to answer that, but if you're a party, if you end up being a knowing party, not that they actively tried to do it, but they obviously knew what was going on and they were making money off of it, then they may have some legal culpability there.
Yeah,
I'd rather see, if it's a question coming down on someone, I'd rather see them going after the platforms because, again, you want to make sure, well, you can't make sure this never happens again, but you want to make it less likely that something like this happens again. Just because, again, it's not that I have any sympathy for Melvin Capital at all, but you just don't want to create a situation where you're having stock manipulation. And obviously, as I say, it happens from the big boys. If you could stop it there, absolutely do it. But when you have, a mass of actors like this doing it, yeah, you should try to stop it.
Yeah, well, I guess the last question I've got for you, though, there's a whole industry, around this. It's just not Reddit, one of these message boards. I mean, you turn on, CNBC or, any of the, Fox Business or any of these where you've got Kramer or any of these talking heads who are out there either, saying, you buy this or don't buy that. How's that any different?
Well, again, the question is whether they're giving advice based on their honest opinion or whether they're giving advice based on the sense getting kickbacks. And there was a famous Henry Blodgett. He I don't know if he formally confessed, but he was charged and paid a lot of money as a fine. He was an analyst for, I believe, was Merrill Lynch back in the dot-com days, and he was touting stocks that he had an interest in. So, if Kramer gets out there, he might give bad advice. I mean, he's entertaining. I've seen him a couple times, very entertaining character, and I have no idea what sort of research he does. I mean, I wouldn't invest based on his advice, whatever. But in any case, there's no crime to giving bad advice, and he could, as long as it's honest. But if he's getting paid to hype this stock or talk this stock down, well, that is against the law. That's stock manipulation. So again, that's the sort of thing. It's not easy to prove, but if you find a check from someone at Merrill Lynch to Kramer saying, "Hey, will you hype this stock?" Well, then you can nail him. That's against the law.
There you go. Well, we'll see how it's going to play out. It's entertaining, if nothing else. But Dean, I appreciate you taking some time and explaining this to us. Thanks so much.
Thanks a lot for having me on.
I appreciate it. Dean Baker, senior economist there at the Center for Economic and Policy Research. We'll get a link out to his piece here in a second on social media. Quick break. Right back. Stick around.
Remembering that united we bargain, divided we beg. Rick Smith.